Hello, everyone, and welcome back to another episode. I'm your host, the Millennial Investor, and today we're going to talk about dividend investing versus growth investing. What is the difference between these two strategies? Why did I choose dividend growth investing for my stock market investing strategy rather than the typical growth investing? What are the two differences between these two? And I want to go ahead and give credit to one of the guys that commented on my channel. This is his name right here. I got this comment about a week ago on one of my previous videos, and I've been waiting to make a video about this, so I'm going to go ahead and read it right here. I get the pull of dividend growth investing strategy. I do use it myself too, but try to keep it at 1/3 of my portfolio since I'm so young. All dividend yield stocks I have are these ultra boring mega corporations, which will most likely outlast my own life. Are you completely against having any growth stocks whatsoever? Take Tesla for example. If they manage to get their robo-taxi network up and running together with improved autonomous driving, we're talking about a transportation revolution on a similar magnitude of how the industrialization affected manufacturing. How much do you reckon that is worth? Had I just trusted my gut about this back when I started looking into it, I would have earned several times my money already in less than a year. At least I am invested in it now thanks to what the Rona did to the price. Well, first of all, I'd like to thank you so much for the comment. I respect any and all comments, likes, subscribes to the video, and I love when people give me video recommendations and very intriguing questions because I love to answer them in a video or just back in a comment reply. As you can see, I replied to them right back there. We're also going to be showing an update to an increase on my dividend income with a $100 deposit that we made this week. We're going to be talking about $100 billion worth of buyback programs that Apple may be adding. Then we're also going to be talking about this morning IBM decided to boost their quarterly dividend. So as usual, before we get into any of that, we're going to get started with the performance of my portfolio. And if you like watching my content and you're interested in using M1 Finance, make sure to use this link down below. And I'll make sure to mention you in the video and we'll each get $10 for signing up. I'll put that in my dividend growth portfolio and I'll make sure to mention you in the video. So to start off, my portfolio has been doing very good. We are at a new all-time high. We're at $1,924, as you can see our chart right here. And so far on the day, we are up about 1.18% or about $22.42 worth of market gain. And in total, we are up $227.32 or about 14.5%, with $224 coming from market gain and about $2.81 coming from earned dividends. Like I said, I'm a dividend growth investor, so that number is more important. To see some of the biggest gainers in the portfolio, we're almost up 40% now on Cisco. Cisco has pretty much been in a straight line up. It's pretty insane to see. And then we have several stocks here that are back up in the 20 and 30% range now that we've had a couple of green days in the market. And out of the 30 stocks in the portfolio, everything we have now is up, including Caterpillar. And Caterpillar was the only one that we had that was actually down for about a week or so. So all 30 of the companies we have now are up in the portfolio. And we actually just received a dividend from Caterpillar just the other day. So let's go to my activity here, and you'll see that I deposited another $100 to the portfolio. So I've now deposited $1,700, and the portfolio is worth about $1,923. So in that $100 that I deposited, we purchased 25 of the 30 companies I own. I'm not going to go through them one by one here. I'm just going to scroll through so you guys can see what I purchased and how much I put into each one of them. The largest purchase in the portfolio was Realty Income, which is the second largest stock in my portfolio. And I'm really excited to see my dividend income going up every single month. So as you can see here, this is what has been added this month. We started this YouTube channel about a month ago, about 3.5 weeks ago from the time I'm filming this video. This is my dividend income based on an annual basis. This is what the dividend income has increased for the year based off of this month from the $200 I've deposited as well as the dividend raises. So this is what it paid before and this is what it pays today based off what I own. And it has increased $8.67 and it's went from $66.67 to up to $75.34. So we'll be updating these numbers when we get to the end of the month by next week. And this is why I wanted to point out this Google sheet that I made here with these graphs and this charts, because we've only had this for 3 weeks and you can see how these are on an uptrend and how these are increasing every single month. And I wanted to bring this up because now we're going to jump into the reason you came to this video, which is dividend investing versus growth investing. So I have an article pulled up here. It is from a very popular website, which is Simply Safe Dividends. It has 5 reasons to be a dividend growth investor. So all these are very, very important points, so I'll be giving my opinion on. So the first one I want to point out here, before I get to the reason number 1, it says, over the past 20 years, the average investor has returned 2.1% over the last 2 decades. 2.1%. Now that is compared to the annualized returns of the S&P 500 stocks and 5.3% for bonds. So even bonds are about 2.5 times the performance of that of the average investor. I've said many times on this channel that I believe emotion makes up for about 90% of mistakes in the stock market. Emotion is what drives people to make horrible decisions with their stock investing. They are not investing in businesses, they're just buying a stock and hope to God it goes up so they can sell it for a later price. This is not what I'm doing. I'm investing in these companies for the long term and they pay me dividends while I own them, while they appreciate in share price. So my ownership is increasing in value. So what we're going to do, the person that gave me that comment in the channel, he recommended Tesla. So the reason why I wanted to bring this up is that is one of the only stocks that I've ever considered that is a non-dividend paying stock to add to this portfolio. The reason is because I am a huge, huge bull on Tesla. I think that they have massive opportunity ahead of them. I think they will be very successful in the future. I absolutely love this company, not only as an investor, but as a consumer as well. They are a very well-run company. I'm sure all of you know that their CEO is very, very popular, Elon Musk. Elon Musk has done other things such as creating SpaceX and the Boring Company and PayPal and so many other things. And there's so many other reasons why he's so popular, but Tesla is definitely his golden child, his number one. But Tesla is a company that I've really considered adding to this portfolio. I just don't want to add it unless I got it at an amazing price, preferably like in the 300 to maybe even 200 range. Probably won't get it back in the 200s. Probably won't ever see that again, but maybe if it ever dipped back to the 300s, I would consider opening a position if it could get it to stay in the 300s for a little while. So first off, the number one reason is dividends are a major source of long-term market returns. So as you can see here, this is the S&P 500 dividend contribution to total return, and that is the S&P 500 price return only. So as you can see here, in the 1940s, 67%, 30%, 44, 73, 28, 16. A huge part of market gains comes strictly from dividend reinvestments. People will take those profits and they'll do the exact same thing that I am. They're taking those profits and they are reinvesting them back into the stock. Now, the beauty of that is those dividends that you reinvest also receive dividends. And those dividends that you reinvest will get raised by the amount of dividends. So speaking of dividend raises, I said we'd be going over this in the video. In recent weeks, we've had a recession hit us, with the Rona hitting us in the matter of no time and everything just going to crap with over 20 million jobs lost in the span of a month. How do we invest in a time like this where everything is shut down, everybody is panicking? But if you notice something about my portfolio in the 30 stocks, those of you that keep up with my portfolio, not only have we not had any stocks cut their dividends yet, but we've also had, I think it's 5 companies in the 3 weeks that we've started this YouTube channel raise their dividend. I know we've had IBM, we just had NextEra Energy Partners. We've had so many stocks raise their dividends. We're not just investing in a random guess or what article we ran that today, what kind of stock we think is going to go up tomorrow, because honestly, I don't know where these stocks are going to go tomorrow. We're focused on the dividends. So IBM boosts quarterly dividend by a penny and the stock gains. IBM announced Tuesday that it is raising its quarterly dividend to $1.63 a share, which marks an increase of a penny. The dividend will be payable on June 10th to shareholders as of May 8th. And down here, I wanted to read this quote right here. IBM is, quote, fully committed to its dividend even during this unprecedented time, he continued. So not only does the stock go up when they raise their dividend, investors who are excited to see that they're boosting their income will not only buy the stock, so that gives you share price appreciation as well. As you can see here, as the time I'm filming this, it's up about 0.73%. As well as a dividend increase. So share price gains come along with dividend increases as well. So my annual income will be going up in IBM, and I did update it here on the portfolio. It was 355 and now it's 387. So IBM is a perfect example of a stock that I own that is increasing its dividend along the way. So whether or not IBM goes up, goes down over the next 6, 12, 18 months, I'll be getting this dividend income, and it is a very good sign that the CEOs, that the board of directors, all of that stuff is focused on maintaining that dividend and raising that dividend. IBM is a dividend aristocrat, and they have raised their dividend for several years in a row, and I don't think they're going to stop anytime soon. Comparing this to, say, a Tesla that we were comparing. Now, Tesla, for example, has a huge potential ahead of them. It's one of the only reasons I've considered them. But let's compare it to another growth stock. So let's compare it to Shopify. Shopify, for example, is a very popular stock. Shopify has had massive growth in the last 5 years. Look at this stock chart. They were a $27, $28 stock, and now they're $630, and they're pretty much at their all-time high right now as we speak. So Shopify is a company that has been unprofitable basically since its existence. The growth, the revenue growth for this company is absolutely massive. Now, the reason why they can't pay a dividend is because they don't hardly really have profits to pay it out. If you have a company that is very old, very stable, so let's just take IBM for example, they just raised their dividend. This company has profits. They pay out profits quarterly. They pay it out to their shareholders. They reward shareholders for the profits that they receive. Shopify does not have profits. They have to have massive revenue growth to incentivize investors to buy their stock. Now, obviously, if you were to buy the stock 5 years ago, you would have about 20 times your investment. You don't have that many opportunities in the stock market. Now, the reason why I wanted to point this out as far as dividend versus growth investing. So with Tesla, let's look at the last 5 years for Tesla. As you can see here, until the last 6 months or so, Tesla has pretty much stayed flat. 5 years ago, they were $220 something, and then if you actually would have been here, if you would have held that stock for 4 years, you would have actually sold it for a loss. If you would have panic sold about the $200 mark or less, you would have actually been selling at a loss. All of the gains you would have had over the last 5 years of the stock has pretty much come within the last 6 months when it nearly shot up to $1,000. So how do you know if Tesla's going to shoot up to 1,000? How do you know if Tesla's going to shoot right back down to 400? Okay, so maybe you see the stock start to go up and you say, oh my gosh, it's about to go so high, and you buy it at $400. So you buy the stock at $400 and you see it go up and up and up and you're super excited. You double your investment, you tripled your investment, and then it starts to go down. Do you panic sell and do you sell at 360? Do you get back to break even at 400 and say, oh my gosh, I just want to break even. I don't want to lose any money on the stock. I'll just sell at 400. And then look what happens. It goes right back up. Now looking from here to today. Today it's about $780. It's right back up here, getting close to its all-time highs. I think just because it's a well-run company, eventually, it might be tomorrow, it might be 3 years from now, eventually the stock will be well over $1,000. I think the stock will be a 2, 3, 4, 5,000 stock eventually. We're talking several years, maybe a decade down the line. But who knows in the short term where the stock is going to go. So talking about for me purchasing the stock, the only way I would buy it is if I could very luckily, if it even ever reaches that level again, catch it in the 300s. So dividend investing is not about timing the market, it's about time in the market. So the number 2 reason for dividend growth investing, dividend growth stocks have outperformed the stock market over time. And you can see the table here below is comparing dividend growth and initiators, dividend payers, no change in dividend policy, dividend non-payers, dividend cutters and eliminators, and then the S&P. So as you can see here, it's a very downward slope. As you can see here, the dividend cutters and eliminators is actually a negative performance. The reason that companies have to cut their dividend is they are not a financially healthy company. If they have to cut their dividend, they are likely struggling for cash and they have an unsustainable business model. So not only are you receiving paychecks or you're receiving income for the dividend payers, but also their share prices outgrow that of the S&P and other stocks as well. Trying to pick the next stock over the next 5 years that is going to grow massively like a Shopify or a Tesla that is going to explode in share price and trying to time it perfectly at buying it at the right moment and then selling it at the right moment, it's very unrealistic. The best thing to do as far as these growth companies, what I would recommend is trying to buy them at a severely low price compared to what they usually trade at and then just hold them for years. If you really believe in the business model that much, I mentioned many times on the channel that Facebook is a company that I love. I love their valuation. I love their financials. I love the business model. Over the last 5 years, they've had pretty good performance. They've over doubled in share price. And I'm sure if I were to buy Facebook at $185 a share, I'm sure a year from now, 2 years from now, I would probably get pretty substantial share price gains. My ownership will never increase in the company unless I buy more of it. I won't be receiving dividends and then putting those dividends back into the stock. I will just strictly have to buy it and then just wait for my return. The only thing that you can do with these growth stocks is buy it at a certain price and then hopefully you can sell it later. As I was talking here with this chart right here for the reason number 2, you can see this chart right here and it compares the top 30% to the middle 40, the low 30 and the non-payers. I'll let you look at that chart for a second. You can see the difference in performance over the long run. Over the course of a year, 2 years, Shopify, for example, has had massive growth and so has Tesla. But a Shopify, for example, I think is probably near the end of its ropes. I don't know how long it will last. Maybe I'm wrong. I could be wrong. The fact is I'm not willing to take a bet on it and find out either way. So if you want to invest in a Shopify or Tesla, albeit, but I'll be investing in dividend growth companies either way. So the third reason to be a dividend growth investor is dividend growth stocks can help ensure a safe retirement no matter how long you live. So one thing that I see a lot in the stock market, it's always thrown around that you should be more conservative the older you get. When you're young, you should be able to invest in very risky companies and very high growth companies such as the Tesla or whatever. And then each year, each decade you get older, you should get a little bit more conservative as each year passes. Now, I understand the philosophy behind this and the reason why they recommend this, but I think it's a bit childish to say that just because you're young, you should be able to invest more risky. I think honestly, a lot of times you should just be smart regardless of what your age is. Now, the thing is, I'm 20 years old, and I think generally speaking, a lot of people would say that my portfolio is rather conservative. A lot of the companies I have in here are very old companies, McDonald's, PepsiCo, IBM. So investing in the very high growth, hyped up stocks, it should not really matter whether or not you're 20 years old or 65. It shouldn't really matter as to whether or not you're young or old. It's almost like what Warren Buffett once said, and I'm paraphrasing here, but he said, the number one rule of investing is to not lose money. And the second rule is to not break the first rule. When you're investing in dividend stocks, you're almost guaranteeing a return in the stock market because the majority of those stocks will never cut their dividend. The cool part is, as you see my income go up every single month as I make more deposits, as these stocks raise their dividends, as I reinvest my dividends, this number is going to keep on going every single month, and you guys are going to watch me track this day by day, week by week. Who knows how long I'll live? I could die tomorrow. I could live 50 more years. There's no telling. But the good news is, if I do live to live a long life, when I get to be older, I'm going to have substantial income from my dividend payments. It is going to be insane. And hopefully I can pass that down to another generation, such as my future kids, and they can take the benefits from those dividend payments. So that's what my future goal is, and that's what I'm planning on doing with my dividends. The fourth reason is embracing a dividend growth investor's mindset can help you avoid the biggest cause of market underperformance. So this is what is known as loss aversion. What I was talking about here, where people get caught up in the short term. So the thing is, I wanted to highlight one part here on this article. Just as Nike and Coca-Cola don't try to time the global economy by shutting down their businesses during times of economic, market, interest rate uncertainty, the same should apply to your portfolio. So why with this portfolio, why do I always say, let's not worry about the market gain? It's cool to see it go up. Eventually it will go up, but let's focus on this number right here. Why are we focused on that? Because the example it gave us with Coca-Cola, it's not going to shut down its operations just because the market is having a little bit of uncertainty. So you look here at the 5-year chart, you think just because their stock prices drop massively, you think they're going to say, oh, our stock price, we're not worth $60 anymore, now we're only worth $50. We're going to stop selling Coke. What would be the reason is that? What would be the reason in selling your stock, stopping the operations, just because the share price is telling you what something is worth? Now here's the thing, if you notice, this stock price moves up, down, up, down, up, up, down. But this dividend payment is a steady line up. 33, 35, 37, 39, 40, and now we're up to 41. You see a trend here? This is a steady line up, continual dividend payments. But this chart for the stock price, it moves up, it moves down, it could go sideways, who knows? But the point is, investing in these businesses, you shouldn't be buying stocks, you should be buying businesses. If you went out tomorrow and you bought a physical property, if you bought actual real estate for a store that sold Coca-Cola, if you typically sold 100 bottles of Coca-Cola that month, but that month you only sold 80 because of the recession that hit, would you stop selling Coca-Cola and would you shut down that store because you only sold 80? No, that wouldn't make any sense. So the same thing here where it's talking about embracing a dividend growth investor's mindset can help you avoid the biggest cause of market underperformance, which is loss aversion. People that have their stocks go down, they get panic stricken, as you can see right here, and they go, oh my gosh, I don't want to lose any more money, I have to sell. And then the moment that happens, the market goes up. And the same thing for the other side of the stock market. You see the euphoric side, stocks go up and up and up, and they go, oh my gosh, I'm making so much money, this is never going to stop. And then it starts to go down. So as you can see here, this is the cycle that goes through in the stock market. And you can see a similar situation here. We were euphoric, and then it started, and then it went down and down and down, and then we hit a panic stricken, And I'm sure right now we're usually right around this cautious stage right here. It's where we're recovering from the panic-stricken bottom and we're starting to go up, but everybody's still kind of nervous and they don't know where anything's going to go, so they're not sure what to do. So if you go here to the fifth reason for being a dividend growth investor, it's being a dividend growth investor can help you earn a return no matter what the stock prices are doing. Remember what I just gave you with that example for Coca-Cola? You could have bought Coca-Cola at $60 a share and you would be down $13 a share. But no matter what, eventually you're going to be up in the long run. Why is that? Well, first of all, these dividend payments are coming up. And these dividend payments are also going to be raised every single year. And eventually, not only will the dividend payments grow, but the stock price will break well above 60 in the future. Do you think Coca-Cola is never going to go back above 60 again? The reason why we know Coca-Cola is going to go back above 60 eventually, what was the first reason of this list out of the 5? You can see here, a big part of the returns in the S&P 500 is strictly dividend reinvestments. Well, that especially goes for these dividend payers. When I get my dividends from Coca-Cola, I'm buying more Coca-Cola. I'm increasing my equity in Coca-Cola. There are so many other people, there are millions of different investors that are doing the exact same thing that I am. As soon as they get their dividend payments, they're buying more Coca-Cola so they can get more dividends. So the same thing goes for number 5 on the reason for the reasons to be a dividend growth investor. It gives you return no matter what stock prices are doing. The stock market for a long time after the 2000 dot-com bubble pretty much traded flat for nearly a decade. Imagine if you were a growth investor or you were investing in the S&P 500, you would have got little to no returns or even negative returns. If you're a dividend investor, you're receiving something and you can get more equity and buy these companies when they're in a dip. If you buy that stock of Coca-Cola when it's at $60 and you get a dividend for 41 cents, well great, now you can buy the stock at $45. So now your average cost for share price on this company is no longer 60, it's now 50 something. You see companies like this, like Apple for example. Apple is one of the holdings in my portfolio. If we go to my portfolio, Apple makes up a 2% slice in my portfolio in the M1 Finance pie. And Apple is a company that does not have a substantial dividend yield. They do have high dividend growth, as you can see here, over the last 5 years. They have raised it pretty decently from 52 up to 57, up to 63, up to 73, and now it's up to 77. But one of the reasons why I own Apple is because of things like this. The reason the share price has done so good over the last several years is because analysts project that Apple is going to expect to add up to 100 billion worth of share buybacks. That is so incredibly massive, especially while several other companies are cutting their share buybacks, halting dividends, stuff like that. This is something that is used to pretty much artificially inflate stock prices. I'm a little bit kind of on the fence about share buybacks, but as you can see here, Apple, already being arguably the largest company in the world, has over doubled in the last 5 years, and it's looking to maybe even grow more. Regardless, I'm willing to take that chance on Apple because there is dividends being paid. It is growing the dividend every single year. If Tesla had a dividend, if at least 1% or at least a good dividend growth, I would 100% would have already owned it. I don't think dividend will be paid out for Tesla for a long time, unfortunately, but at least Apple pays me something while I own it. So even if Apple goes down, not only will I be getting dividends, but that dividend will be raised every single month. So as you can see here through my portfolio, as I always mention through the end of my videos, if you would like to use M1 Finance yourself, make sure to use this link right here. It is in the description of all of my videos. We can each get $10 and I can put that towards the portfolio. And I'll make sure to mention you in a future video. So thank you guys so much for watching. Make sure to comment down below. I've been getting a lot of nice comments from you guys recently, asking me questions about stocks, asking me help with your portfolio. Make sure to let me know down in the comments. I really appreciate any and all subscribers. We just broke over 200 subscribers just a few days ago. And even though it's only 200, I know that's not a whole lot compared to so many other YouTubers out there. Honest to God, it really does mean so much to me, and I appreciate every single like, comment, view, everything. So thank you guys so much for watching, and I'll see you next time.